The next strategy we use is actually what I like to call a cash flow play. Cash is king in business. You always need to look for ways to trap in cash. On this episode, we'll be talking about the 9 funding and financing strategies we used in bootstrapping during a mini food manufacturing business and building a brand out of it. We'll show you how we literally built the business from a nano business, which typically means any business generating less than 3 million naira annually, to a small scale business, which typically means a business generating less than 100 million naira actually. Strategy number 1, startup funding. What we did was to call a group of persons together and show them this is what we're going to do. We shared the vision with them and had a couple of them sign up to become a distributor. So that's how we raised our startup funding. So in your own case, this could be talking to family and friends, it could be talking to colleagues, whoever you think you can persuade them on your vision for them to put money in. The second financing strategy we used was actual sales of a sample product. So when we first developed the product, we needed to test the market. So we had already distributors. Remember, they had given us the money up front to actually make the product. So as much as they did, we also had to internally hire sales representatives. You would say you didn't have money, but you hired sales representative. Yes. How did we do it? We structured the sales representative compensation into a commission structure. So that basically means that they get paid based on what they sell. So we had people come in, young people, and then of course they take the product, literally go out to the market, hawking style, take it to the market, talk to people, and a couple of them did quite amazingly well. They were able to push the product, sell it, and even bring in some distributors as a result of that while we were still testing. Remember, as at this point we had no NAFDAC, no nothing, we were still in product development phase, and as a result of testing it, we got feedback, we were able to iterate the product. We hired first, designed a commission structure that rewarded them for actual sales, and a few people that decided to take on the challenge, they made some money from it. We also made money as a process, and that was one of the ways we were able to generate capital to sustain the business. The third strategy we employed was actually something that came to us. We've always heard of angel investors, but we experienced this. So while we were doing this market testing, one of our distributors were able to show the product to a lady, and the woman was so impressed with the product that she said she had an amazing testimonial with the product, so she wanted to meet the people behind the development of this product. And when they took me there, she was like, "Are you kidding me? Are you the one behind this? Young men like you? Wow." She was so blown away, she was so impressed, and as a result she asked us because as at this time we didn't have NAFDAC number. She was like, "What will it take for you to secure NAFDAC number so that we can take this to another level?" And of course we told her, and I can remember she said, "Well, I cannot afford all the money that you require," but she gave us what she could afford, which was quite a lot for us at that time. She gave us as her own contribution towards us getting a NAFDAC registration, and that for me was nothing short of a miracle. I mean, we know her from nowhere. She didn't know anything about us. She didn't even come to the factory or any. So this is a very important thing. Many people go around setting up factories, setting up equipment, doing all of this, investing millions without actually even testing if customers will be interested in this product. So we already understood this. So we started with market testing first to ensure that we gain acceptability in the market. Number 4 is simple. Get the word out there. Make sure you are out there. Make sure you are spreading enough noise, and make sure that you take your products to the places where it matters. People that need to see it while you are still in development phase. Don't wait for all conditions to be right or perfect or anything. So what did we do in this phase? We heard about several grants. There are several grants, awards, and several grant programs several startup funding and all those competitions and programs that were all running. I typically asked, I asked my team then, I said, okay, we are in Nigeria. Have we ever gone to the Bank of Industry to say, this is what we are working on? How can you guys help us? So we went there. We went to Bank of Industry. Then we had what we call the NISAL loan. So we applied for that. Sterling Bank was doing a program. We applied for that. Whatever it is that we heard or knew about, we went out for it. One of such was the British Council Business Acceleration Program. During the course of it, there was a competition and we competed. The British Council were impressed with our product, impressed with what we were trying to do, and as a result, we were given a grant recognition award, and that also brought in finance to us, and plus that of the angel investor, we were able to now fully engage with the NAFDAC registration process. And one of the things that we took advantage during the NAFDAC registration process was the fact that the Buhari-led government at the time were doing something for small-scale businesses, SMEs generally. So there was like a discount on NAFDAC registration. I think it was about 90% discount for micro and small-scale businesses as at that time. If my numbers may not be correct, but I think it was about 90% discount. So we were able to take advantage of that and use that to quickly and rapidly secure our NAFDAC, even though it was a very tedious process, but we did it by ourselves. We did not hire anybody. We went through the entire process by ourselves, and then we walked in. And I always encourage entrepreneurs, courage is one of the things that is required. These institutions, we walked into CBN and asked them, what do you guys have for micro and small scale businesses? And they told us, and so we knew the requirement. We did not meet it, yes, but we at least knew the requirement. So we worked on ourselves to a point that if we are able to meet this requirement, we can come back to CBN and ask them for funding. So that's typically what I tell entrepreneurs. Go out there, the opportunities, knock on doors, ask them, what do you guys have for small and medium scale enterprises? The worst that can happen is they don't have anything for you. But if they do, you participate. So the next strategy we use is actually what I like to call a cash flow play. Cash is king in business. You always need to look for ways to trap in cash in your business. I knew this. I remember I have a business background, so I understood how cash flow can really impact a business. So one of the things I was able to do with our team is that we looked at our cash flow and decided to see how we can play with some financial strategies to adjust the cash flow to our advantage. And one of the things you need to look out for is your accounts receivables and your account payables. So we started developing strategies to limit our account receivables and also to increase our account payable. That way we're able to trap cash internally. So one of the things we did in terms of the account receivable is that typically when you supply supermarkets and co, some of them pay you after 70% of sales of your product. Some of them pay you after 60 days, some after 45 days, depending on their own structure. We cannot afford for our money to be out there for 60 days, which is a long time for us. So what we decided to do was to try to talk to banks and see if we can get funding for purchase orders. But the banking process was taking too long. So what did we do? And of course, they said we needed to build inflow and all of this and all of that. We said no problem. But what could we do? We simply now spoke to potential investors, people our contact, and said, okay, so we have this order from this established supermarket. They pay every 60 days. Of course, this is very important. One of the things I learned in business was to always under-promise and over-deliver. So what we did, if we knew that the organization, that particular retail agency, that particular retail outlet, that supermarket pays every 45 days, we will tell the prospective investor that they pay every 60 days. So what typically means, in case there's a delay or any other thing like that, we allow that 15 days extra for any offset or any change in plans. So what did we do? We get this investor to give us the money upfront. We use the money to produce, and then when the store pays, we pay the investor with a little bit of interest. This was one of the strategies that allowed us to quickly spread to over 100 retail outlets. Why? Because we were not tying money down and waiting for supermarkets to pay us. Rather, we get investors to scale with us. So immediately we get this store and then we lock them in. We get someone that typically finances our supply to them. We move to the next store, do the same thing, move to the next store, do the same thing. It was a very clever strategy. Number 6 was account payable. So we needed to also look for strategies around account payables. Remember, that was a strategy for account receivable. So now we needed to look for a strategy around account payable. How can we delay paying people? Example, our suppliers. Example, our distributors. How can we delay paying them so that we can trap some cash internally and was able to use this cash to sort out our growth, to fund our growth. So one of the things we did first was what we call distributor threshold. So because of the structure we used, people could actually become distributors by buying not so large a quantity. Remember, we were just small and just starting. So we didn't put a threshold that was too expensive for someone to become a distributor, because our entire strategy of growth was around spreading fast. So we needed distributors. We made the threshold very low for distributors to be able to quickly for it to be easy for someone to become a distributor. And then the next thing we did was, now we had a referrals program where you could also refer other distributors. So that helped us in really expanding the distributorship program very fast. But what we introduced to trap cash for us was what we call payout threshold. So a payout threshold, what we did was, for you to earn a commission from us, this is different from the markup on the product. For you to earn a commission from us for your referral and from your purchase and all of that, all those kind of incentives, you need to meet a certain threshold. So let's say so that threshold was a financial threshold. So if your commission is not up to 50,000, we are not going to pay out. So as a result, if for those that had 40,000, 30,000, 20,000, that money still remain with us. So if you multiply that by, let's say, if you multiply 40,000 times 10, that's 400,000. We use that money to still grow the business. So that threshold was a strategy for us to retain cash. This is high level financial play here. So a lot of major companies use this. So we were able to introduce this to our small business as well. And it's something, if you look around your system, you can see ideas on how to retain cash internally, which is called delaying your account payable. So you are eventually going to pay, but in the meantime, you trap this cash internally into your system so that you're able to use it to fund other business activities. Remember, you're limited on cash, so you need to get very creative. So the second account payable strategy, which is something that most people are aware, is what we call supplier credit. So one of the things we did was to maintain the same type of suppliers for our inputs, for our raw materials, for our ingredients. And so as a result of that, we built a business relationship with them to a point that they could give us the input, and then we'll pay them back. We'll pay them at the next order, which is typically within 30 days. So that way we're able to still trap some money in. So someone can supply us, let's say, 500,000 worth of grains, and we'll pay them maybe 30 days after. You see, so we literally trapped the money internally, and that allowed us from some financing to be able to use and still fund other activities. So basically, because you're small and you have limited cash, what you're almost like a disc jockey, a DJ, just allocating resources, your lean resources. You're trying to trap as much as possible to be able to allocate to salary, to growth, to buying of equipment, to doing all of this. Why? You have little resources, so you need to be efficient in managing it and allocating it. Number 8, it's inventory management. So this is one of the major things that one of the strategies we used in financing our growth. So inventory management for us was about production, storage, and packaging. So those were the core inventory that we had. So what did we do? We made sure that we did not have excess packaging that we require. So we always ordered in small bulk, in small volume. So we did not have excess packaging that we just stored for a long time and a long period. And someone will say, yes, if you produce in large quantity, you're likely to get it at a more affordable rate. Well, my counter argument is time value of money. If you lock down a lot of money over a long period of time, you lose the time value of money. And what I simply mean in that English is this. First of all, we don't even have enough resources. So we literally needed to produce the packaging materials in small quantities. And as a result, that means that the per unit price of the packaging material will be higher than if we were able to produce in large volume. But also realize that if you produce in too much large volume, you're just literally tying money down in form of packaging, in form of inventory, whereas that money would have been used to make another money in another area. So what we did was to make sure that our packaging we did it in small quantities, so that almost on demand kind of thing. So that way, and that also helped us in product pricing, because if you can price and sell your products very comfortably when you are producing your units price of packaging at a higher cost, so when you are growing, your cost of production will literally drop, because you will be able to produce in large volume of packaging and a lesser cost. So that was part of the argument we used, and of course this helped us in saving money. And then in terms of inventory, we tried to understand our demand. So we made sure that we did not have excessive inventory on raw materials and inputs. And also we did not have excessive inventory on stored finished products. So we don't have a large volume of finished product that is ready to be sold when we don't have a corresponding demand. So if you've done your business for quite a while, you should be able to have a fair understanding on your inventory. And one of the things we were able to do was to make sure we had proper inventory systems. So softwares that we were able to use, most of those softwares, they are even free version, especially if they're a small scale business. And you could use them to track your inventory so that you could see what you sold and in November, in January, and then in February and in March. And then you could see a pattern after a while. That pattern will now help you to be able to plan properly. So that is one of the 8 funding and financing strategy we were able to deploy. And then number 9 was outsourcing, just like packaging. So what we did with outsourcing is, as we began to grow, we needed bigger machines. But of course, we could not carry our money and tie down in machines. When I always say tie down, manufacturing is capital intensive, and this is one thing many business owners miss. So manufacturing and production is very capital intensive. So and then most times you need to pay upfront. In Africa, we don't have a lot of credit facility that allows for you to be able to get these machines and pay over time. So you literally need to pay upfront, which is what we call capital expenditure, capex. You literally need to pay in millions upfront for machines that you barely have demand to meet up the production capacity of the machine. So what we did was to go for the smaller scale machines, for the very critical machinery that we needed, especially for NAFDAC certification. Every other machine we outsourced. And for someone who argue the cost of production will be higher if you outsource, yes, I typically say it is better than using millions to go and buy machine and keep when you don't even have demand for the capacity of that machine. If you look around, you'll see a lot of factories with with massive machines, and they don't have corresponding orders, so that machine is constantly functioning on under capacity, and of course the cost of maintaining the machines. So what did we do? We simply outsourced the areas of the production process we could outsource to those who have bigger machines, and of course those machines are redundant, and then we outsource to them. It cost us higher in terms of unit price, but if you look at the grand scheme of things, you realize that it's a smarter approach to financing. Why? Because those millions that we didn't have in the first instance, by the time we started generating some revenue, instead of tying the money down in machine, we put the money where it matters most, which is what marketing and better product quality, research and development, instead of tying it down to a machine that we could keep simply hire per use. That makes up the 9 funding and financing strategy we used in bootstrapping our food production business in Nigeria. The brand name was AfriLife. It was an interesting journey. So if you like this episode, if you learned a thing or two, I'd like for you to go in the comment section and tell us 1 or 2 things you have learned and you're going to likely apply to your business. And of course, most importantly, subscribe, share this video so that others can also learn a thing or two, and together we build the continent of Africa, from one micro business to the other. Like I always say, we have a continent to build. Pick a problem. See you on the next episode.